Hello and welcome to lesson number 2. What we're going to do today is have a detailed look at individual currency strength and weakness, because this is the cornerstone of successful forex trading. Now, before we get started, I want you to do something. Here are 3 charts: the Euro Swiss franc, the Euro US dollar, and the Euro CAD. I'll show you them one at a time in just a moment so you can see them in a bit more detail. And what I want you to do is pause the video on each chart, have a quick look at it, and then decide which direction the price will go next. Just play along with this. This is only for your benefit. It's not a test or anything like that, but it will be very interesting to you a little bit later in the lesson, and it will make your understanding of this lesson far more beneficial. So I'll hold each one up for a few seconds. You pause the video, pick a direction based on what it looks like to you. Is it more likely to go up next or more likely to go down? Write that down on a piece of paper, and then we'll come back to these charts a little bit later on and find something extremely interesting from it. So here's the Euro Swiss franc, here's the Euro US dollar, and here's the Euro Canadian dollar. Okay, if you've done that, let's get into the lesson. As I said, today we're talking about individual currency strength and weakness, which means we're going to be looking at the main dashboard in isolation for now. We'll talk about the core volumes and the bid-ask indicators separately in later lessons. So individual strength and weakness is the core principle behind profitable currency trading. If I was only able to teach you one thing, it would be this, because it makes the biggest difference and has the greatest effect on profitability over everything else. Matching strength against weakness is the single biggest edge that you have as a currency trader, and it's something that just isn't available to the same degree in other markets. If you remember in the webinar that you attended, I gave you the imaginary example of being able to pick a weak stock and match it against a strong stock and effectively create the ideal market to trade for the biggest trends and maximum profits. Well, of course, that's an imaginary make-believe situation that isn't possible in stock trading or any other market. But it is something that's possible in Forex, because Forex is actually multiple different markets that you can mix and match. You literally do have the ability to pick and choose the best currency and trade it against the worst currency. And that's a level of freedom that just can't be underestimated. And thinking back to the last lesson, I explained that the majority of orders in the market are initiated by banks. We've got 2 major players in Forex: the bank dealing desks and market makers. Market makers are the liquidity providers and basically act as the counterparty to every transaction, but it's the banks who control most of the actual customer side orders. And as such, it's the banks who are predominantly responsible for pushing the prices of currencies up and down. So this lesson is going to look at how banks operate and how we can recognize their trading patterns using the advanced market analysis software. Now, I realize you don't have access to this yet, but as I explained, this is just a tool. And like all tools, it is useless in the hands of someone who doesn't know what it's for and how to use it correctly. So the whole point of this course is to teach you how this and our other advanced tools work and how they can be used. And then, armed with a proper understanding, you can make an informed decision about picking these up and using them for your own benefit. So bear with me while we go through the theory before you progress on to any practical application. Okay, first of all, let's look at what the bank dealing desk is and how they operate. Knowing what they do will help us take advantage and profit. A bank dealing desk is the busy trading floor that you see depicted all the time in movies and in the media. They are large rooms filled with traders talking into phones and frantically looking at their computer screens. It's not quite as manic and cliched as Hollywood makes out, but a dealing desk room is a genuinely large, busy office floor. And the primary job of the individual traders on those floors is to execute orders on behalf of the bank's customers or clients. And I used my own business as an example of this in yesterday's lesson. I do all of my business online in US dollars, but I live in the UK. So I've actually got 2 bank accounts. I have one denominated in US dollars and another in pound sterling. And if I log into my online banking app, I can transfer money from the US dollar account into my pound account at the click of a button, up to a certain amount. And let's say that amount is something small like $10,000. A transaction that small is done internally and instantly with the bank, and it's automated. But if I wanted to convert a larger amount, let's say $100,000, I would have to get a quote. And what would happen is I ask to make the transfer like normal, And that immediately flashes up on the screen of one of the traders on the dealing desk floor. That trader then looks at the market to see where the current price is and will then give me a quote for what exchange rate I can get. I click the button to accept that quote, and then that trader makes the trade in the market for the amount that I've asked for. The vast majority of bank dealing desk activity is just like this. They get customer requests, flash up on their screens or come in over the phone, and they execute a trade on behalf of that customer. And the size of the orders that they're executing can range from small amounts like the example I've just given you up to hundreds of millions or even billions. For example, last year, a UK software company bought out a division of Hewlett-Packard in the US for $8 billion. Well, to do that, the UK company had to convert their British pounds into US dollars to pay that US company. And that would have gone via a bank dealing desk. When Google UK want to convert profits to repatriate back to the US, they have to go through their bank to exchange one currency for the other. Every transaction like this follows the same process. Anyone who wants to exchange one currency for another goes through their bank, and the bank executes or arranges the transaction on their behalf. Even large hedge funds, when they're speculating and making investments, will usually have to arrange the trade through a bank, just like this. Forex is an interbank marketplace. Whereas stocks are traded via stock exchanges, currencies are traded via banks. The interbank market is the currency equivalent of a stock exchange, so almost everything goes through the banks. Now, as with everything else, we're on an introduction course here, so I am obviously simplifying things. It is far more complex than that, and banks also speculate for themselves as well, and there are other elements that can cause the price to move. But on the whole, the majority of banking activity is generated on dealing desk floors in this way, and most real orders are executed via banks on behalf of customers, large and small. You don't have to worry about the micro details or anything complicated. All you have to know and remember is that bank dealing desks are responsible for most real order transactions and price moves. These are the guys that move the markets. And if we want to make a profit, we really want to be able to see where the banks are trading so that we can go along for the ride. We want to follow the real orders and avoid those ghost moves that I talked about in the last lesson. And we can do that by monitoring individual currency strengths and weaknesses. On the analysis software, every element is looking at individual currencies, and we've got the ability to look at multiple different time periods using the 3 boxes at the bottom. You can look at anything from minutes to months or even specific hours during the day. We'll come back to the customization, the various elements later in the course, but for now, I just want to cover the basics so that you understand what is being measured and then some general patterns to look for and how the information will help differentiate between real moves from those ghost moves. Now, each country prints its own money and decides how much supply there is. In other words, each country decides how much of its own currency exists. And as you're probably aware, each country just prints more and more when they want it. It's called quantitative easing, which is a fancy term for printing money out of thin air. Regardless of the pros and cons of that or the implications for the future, in terms of the Forex market, it makes no difference because every currency is valued or compared in relative terms against every other currency. So here we've got the UK economy and its money supply of British pounds. That is then compared against the United States to determine if £1 is worth more or less than $1 and by how much. The market is, in very simple terms, making a comparison of the two economies and deciding how they stand up against each other, basically valuing them against each other. But the pound is not only compared against the US dollar, it is also compared against the euro and the Japanese yen and so on with every other country and currency. And as a result, what you find is that the pound may be weak compared to the US dollar, but actually it's strong compared to the Japanese yen. And of course, every currency does the same thing. They're all compared individually against all of the others, and against some they may be stronger and against others they may be weaker. That could be quite confusing if you were looking at pair charts. You know, how can the pound be going up on one and down on another? Well, that's why we don't look at pair charts. We look at individual currencies instead, and this is how we do that. These are the top 8 major currencies in the world that we're interested in. They've got the euro, the yen, the Australian dollar, the British pound, the Canadian dollar, the Swiss franc, the New Zealand dollar, and of course the US dollar. 88% of all spot Forex transactions happen on those currencies. You've got the Chinese yuan, Swedish krona, and the Mexican peso, and they all actually have slightly higher volume than the New Zealand dollar, but the liquidity and the cost and the access to them is less favorable, which is why the New Zealand dollar makes the list ahead of them for trading purposes. So each of these 8 is compared against the other 7, which is what gives us the 28 different pair charts in total that can be traded. So there are 7 euro pairs, there are 7 British pound pairs, 7 US dollar pairs, and so on. So to determine the overall value of the euro, we have to look at all the pairs that include the euro. And on some, it will be stronger than the other currency, and on others, it will be weaker. And we would add and subtract all of those values together, and the total is the real aggregate value of the euro as a single standalone currency, as though it was its own index or own market. That lets us see how the currency is really performing across the entire market. So let's look at a very simplified example using artificially rounded figures to make things nice and easy to understand. Let's assume that the price of the euro US dollar at 800 in the morning is 100, and the price of the euro New Zealand dollar at 0800 is 200. So that's the starting price. By 0900, the price on both of these pairs has moved down 10 pips. Now, although they've both seen a fall of 10 pips, as a percentage, 10 pips is a bigger proportion on the euro US dollar than on the euro New Zealand dollar. 10 pips out of 100 is 10%, whereas 10 pips out of 200 is only 5%. And this is why the calculations for strengths are made as percentages rather than merely pips. And if we added those two values together, we'd see that the euro as a single currency has fallen in value by 15% if we look at what it's just done on those two pairs. But we would need to do this type of calculation for all 7 pairs that involve the euro. So let's look at this. We've got the euro US dollar plus 1%, the euro pound plus 1%, the euro yen minus 1%, minus 1% for the euro Swiss franc as well. The euro CAD is plus 2, the euro Australian dollar is plus 2, and the euro New Zealand dollar is minus 1. Add and subtract all of that together, and we get a total value for the euro of plus 3% gain, which we would then have to divide by 7 for the 7 pairs that we've just used to give us the final value. And in this example, the euro as a single currency has overall gained a net amount of 0.4% in value against all of the other 7 currencies it's paired against. And we obviously do this calculation for every single currency in their respective groups of 7. And after all of that calculation has been done, we're left with the exact net relative percentage each individual currency has gained or lost across the wider market. And we can see that the euro has gained 0.4, the US dollar has gained 0.2, the New Zealand dollar minus 5, and so on. Now, with every single price change, every second of the day, these calculations would need to be done over and over again. And if you plotted them out on a line graph, it would look like this, with each currency fluctuating up and down as its net value changed relative to the others. That is exactly what the analysis software is doing for you. But instead of laying each currency out in isolation like this, we overlay them on top of each other for a more compact view. That then allows you to make a direct comparison of how each currency is performing against the others. And this will be your primary tool for identifying high probability trades from now on. This is what lets you make a direct assessment of different currency strengths and weaknesses. This basically is what each of the boxes are on the main dashboard that you're going to be using. So how do you interpret this and use the information to make profits? Well, at the most basic of levels, you want to find a currency that is doing particularly well in the market overall and match it against one that is doing particularly poorly. In other words, find the strongest and match it against the weakest. That by itself is enough to give you an edge in the market, even without any other considerations or analysis. This, for all intents and purposes, is following the big money. We can see where the big changes in value are and we can jump on those. But we can be a bit more selective and more sophisticated than that and actually improve our chances of making a profitable trade. Fundamentally, you are looking for strength and weakness. But don't forget that thanks to triangular equilibrium, around about 96% of price fluctuations are not even real, or at least not the result of actual buying and selling. So it isn't good enough to simply find a currency that's above another one. Because of the way the markets work, most currencies are actually just getting pushed around by the more dominant ones. So the trick to making better trades is to identify those dominant currencies. So let's consider what we know so far about bank dealing desks and triangular equilibrium and think about what that telltale pattern might be to be able to read the individual currency lines. Obviously, we can never know for sure where all of the real orders are or who's doing what. We can get a pretty accurate idea using the customer core volumes indicator and market maker bid-ask indicator, but even so, we're really looking for the footprints that the big players leave behind, and they do leave a trail that we can follow. First of all, when banks are exchanging one currency for another, think about what that would look like. Imagine there were only two currencies, the pound, which we'll have as the red line, and the US dollar, which is coloured blue. No other currencies exist for the sake of this example. So that is a straight swap of one currency for another in equal measure. You hand over your US dollars, in other words, you sell your US dollars, and you buy the equivalent amount of British pounds. That would look like this. The pound would go up in value or strength, and the US dollar would go down to weakness, an equal and opposite amount. Go back to our early example of how individual currencies are calculated. With only two currencies, there is only one pair. If at the start the value was 100 and an hour later the value had gone up to 110, what that means is the British pound has gained 10% and the US dollar has lost 10%. It's absolutely equal and opposite, and that's why it would look like this perfect mirror image on the analysis dashboard. Okay, so in that scenario, we can be absolutely certain the real orders are happening on the pound US dollar pair. And I know this is completely exaggerated, but you'll understand why in a moment. Now let's throw in a third currency, the euro, which we'll draw as this pink line. With three currencies, we have three different pairs. And again, we'll assume the real orders are happening on the pound US dollar. What would that look like for the euro? Well, relative to the pound, the euro would get weaker. Remember, when one currency goes up, mathematically, any others that are connected to it must go down in relative proportion. So in this case, the euro goes down. The euro-pound pair chart would then look something like this, with the price falling. But compared to the US dollar, the euro would go up in relative terms. The US dollar is getting weaker. It's losing value, so the pair chart would look like this with the price rising. If you were looking at pair charts, you would see all three of them moving. But how do you know where the real orders are happening? Think back to yesterday's lesson and this slide where I explained that a strong currency versus a flat or neutral currency would result in a trend on a pair chart, as would a weak currency versus a neutral currency. All three of these combinations that you can see would result in an uptrend on the euro-US dollar pair. Looking at the pair chart in isolation, you wouldn't know why that trend was happening. Is this because the euro is strong and the US dollar is weak? Or is it because the euro is strong and the US dollar is flat? Or is it because the US dollar is weak but the euro is flat? There's no way of knowing by looking at a chart. So let's go back to our example where the real orders are on the British pound US dollar. If we put all three currencies next to each other for a direct comparison as individual currencies, it would look like this. The pound is going up and in turn pushing the euro down. But the US dollar is going down and in turn pushing the euro up. So the net effect for the euro as a standalone currency would put it flat, right in the middle. Instantly, you can see where the best move is. There may be a trend on all three pairs, but the biggest and the best move is going to be on the pound US dollar. Now, if we extend that out and added more currencies as we do in the real market, the same sort of patterns would emerge because the relationships are the same as I've just described. It's obviously going to be a little bit more jumbled in the real market, which is what you're looking at here. It's not quite so neat and uniform, but the overall patterns to look for are the same. Currencies that have real orders taking place on them are going to present more of a mirror image. They will tend to move in equal but opposite directions and will very often be the absolute strongest or weakest. Currencies that don't have real orders or are being pushed around through triangular equilibrium would behave more like the euro in that previous example. They will tend to be in the middle of this box. As I said, it is never going to be quite so neat and tidy or perfect as my previous example when we're dealing with the real market. With so many different currencies and so much money in the market, there are real transactions on every currency and every pair every day. So what you tend to have is a mix of real orders as well as those ghost moves. But nevertheless, overall, you do generally get dominant currencies that stand out. And the more they stand out and the more of a mirror image you have, the higher the likelihood of it being a high probability, real order-based move that will produce better profits for you. This screenshot is of the real market conditions that were happening as I was preparing this lesson today. You can see that certain currencies stand out more obviously than others. The euro, for example, in pink, is gradually getting weaker and weaker over the whole day. This point on the left was the London market open at 8 a.m. UK time, and on the right is 8 hours later, just as London was about to close. And you can see the euro actually became the weakest currency almost right from the start, and it stayed there then all day. And on the strong side, you've got the Canadian dollar in green that stands out really obviously, but earlier in the day, the US dollar in blue was also up there as a very strong currency. There's very obviously real orders happening on the euro, and they are sell orders. It's a no-brainer that you only want to sell that currency. Buying it would be a huge mistake. Likewise for the Canadian dollar and US dollar, there are real orders and they're buying orders, so you would only want to buy them. Never trade against the banks. And similarly, look at the Australian dollar, coloured sort of orangey brown down here in the middle. What do you think is happening on that currency? Not much. It's basically hover around the middle. So that means it almost certainly has no or very few real orders. If the banks aren't trading it, would you want to? And let me show you a bit more confirmation here. On the second page of the dashboard, we can see information about tick volumes. And I'm not going to talk about this today because I'm going to go into that in more detail in later lessons. But what I do want to show you is this correlation measurement. What this feature does is tells you how each currency moves in relation to the other. A positive value means that each currency tends to do the same thing in the same time. When one goes up, the other will also go up. And positively correlated currencies should be avoided because there's no imbalance between them. Here, for example, you can see that the euro and the Swiss franc have a positive value of 87%, which means 87% of the time they did the same thing. So there's no trading opportunity there. But look at the euro and the Canadian dollar. They've got a negative value of 87%. So that means 87% of the price moves were in opposite directions. When one went up, the other simultaneously went down. And you already know what that means. Almost certainly, real orders were being exchanged one for the other. I mean, you can see this obviously just by looking at the individual currency lines, but it is nice to have that mathematical confirmation to give you more confidence about where the best conditions are. And let's look at the actual charts to see how this played out. You'll recall the charts that I showed you at the start of the lesson, and hopefully you played along with that and did what I asked you to, and you made a best guess at where you thought the price was going to go next. Well, those charts were just prior to the London market open today while I was preparing this lesson. So these are not cherry-picked examples. It was the real market today. So we've got the euro Swiss franc, the euro US dollar, and the euro Canadian dollar. Obviously, I've got no idea which direction you chose or how you chose them, and you were probably uncertain yourself because, as you know, there's not a lot of useful information on a pair chart. But we've just been looking at the individual strengths and weakness lines for today. So you've now got a pretty good idea of what happened with price and the individual currencies. The euro Swiss franc went nowhere. It just chopped back and forth in a 25 pip range. You wouldn't have gone near that today because both currencies were weak and did the same thing. And you could see that right from the start. The euro US dollar trended down almost 70 pips. The euro Canadian dollar traded down 120 pips. Can you see the difference it makes? Under no circumstances would you have been tempted to buy the euro US dollar, because right at the start of the trading day, from the first minute, the euro went down to weakness and the US dollar went up to strength. This is the most popular pair in the market. More people trade this than anything else. And anyone looking at a chart, like I asked you to at the beginning of this lesson, would have no idea. Is that going to go up or down? You can find all sorts of meaningless reasons to buy or sell using all sorts of hocus-pocus lines and indicators, and I guarantee the split is always close to 50-50, with half of amateur retail traders buying and half of them selling. In other words, they're no better than a coin flip. In fact, here's a screenshot of live trades held by Forex Factory members today. 54% bought, 46% sold. So that is close to 50-50, but with slightly more getting it completely wrong, actually. And here's what traders Oanda did. Almost exactly 50-50. And every day you'll see the same thing. Most retail traders are absolutely clueless and they are trading completely in the blind. Their choices are no better than random, no better than a chimpanzee could do. But when you analyze individual currencies, you are genuinely trading based off real information. It is sophisticated, well-informed trading. You'd never have entered a buy trade on the euro today because you could very clearly see it was pushing down to weakness. The only sensible thing to do would be sell it. The banks are responsible for most price moves. Never trade against the banks. And you can see what the banks are doing. You can see the footprints or the trail that they leave behind, the telltale patterns. And this is only the start. So far, we've only looked at strength and weakness at the most basic level in isolation. We've got 3 different time frames that we can analyze for strength and weakness. And we've got all of the tick volume data and liquidity to add to the equation to give us more of an advantage. And that's before we even get on to the other indicators. But hopefully you can see just how important and powerful individual currency strength and weakness is by itself. As I said at the start, this is the core principle of currency trading and provides you with the single biggest edge available. Everything we do will always fall back on this fundamental element, and I hope this lesson has opened your eyes up to that in a little bit more detail. So let's quickly summarize what we've covered just for today. Remember that bank dealing desks are responsible for most real orders in the market, and most of their trading activity is them executing orders on behalf of customers. And ultimately, we want to follow the banks and trade with them, not against them. And our biggest edge or advantage comes from analyzing individual currencies to match strength against weakness. The real order moves can be identified by bigger moves to strength or weakness, as well as mirror images or negative correlations between currencies. We want to find currencies moving in opposite directions away from each other. And the most important takeaway of all is never ever trade against the banks. Never buy a weak currency, never sell a strong currency. So that wraps up today's lesson. However, we haven't looked at market makers yet. They're the other big market participant that we want to pay attention to in order to increase our edge and profitability. Today, we've looked at the bank dealing desks and individual currency strength and weakness. The next lesson is going to cover market makers and liquidity. Both of these lessons, actually the first 4 in this course, are broad overviews showing you how the market works from a bird's eye perspective, concentrating mostly on the main dashboard. Once we've got these fundamentals complete, we'll then look at the core volumes and the bid and ask indicators, and we will dive into using all 3 of the indicators together to identify patterns and actually look at picking entries and managing positions for the biggest profits possible. So we have still got an awful lot to come. As I said in the last lesson, and I'm going to repeat this in every single lesson until the end of the course, please take the time to rewatch this lesson more than once. Watching a video and then forgetting about it is not going to make you a better trader. You've really got to understand the topics first of all if you want to be able to use the level 2 analysis tools effectively at the end of this course. So please watch this another couple of times so that the information really sinks in and makes sense. I'll leave it there for now though. I hope you've enjoyed it, and please look out for the link to lesson 3 tomorrow. Thank you.